Welcome to the Door World Money Podcast. I'm your host, Rob Berger. Today in episode 336, I'm going to be answering more of your questions. This time, we're going to be talking about where you should put your emergency fund, savings account, bond fund, what the heck is going on with interest rates. Question comes from a listener named Will. Will writes in, he says, "Hi Rob, big fan and avid listener of your podcast. Always enjoy the great information you share. I wanted to pass along the following question and a suggestion. For a possible future podcast subject, I imagine the timely topic would resonate with many of your listeners as well. As of this writing, and just for reference, he sent me this on June 26th of this year. He said, as of this writing, treasuries are yielding a high of less than 1.5%, that's for 30-year maturity, to a low of less than 0.2% for a 3-month T-bill. The Fed has already promised they will keep short-term interest rates effectively at zero until at least 2022. Let me stop there. I didn't actually know they actually said that. I mean, I'm not doubting it, but that seems kind of funny that they would actually project that far out. But in any event, they certainly have interest rates effectively at zero. Will continues. If one is looking to keep a portion of their portfolio in fixed income cash for the next 3 to 7 years, would it not make more sense to allocate such to a high-yield savings account, such as Ally or Capital One, with a rate currently around 1.25%? Now, let me stop there. Keep that number in mind. This was just a month ago he emailed me. 1.25%. Instead of placing in either the Vanguard Short-Term Bond Fund, VSBSX, with a current yield of 14 basis points, or the Vanguard Total Bond Fund, VBTLX, with a higher current yield of 1.39%, but more elevated interest rate risk. Given the choice, am I correct to question why one would take the investment risk of even modestly rising interest rates in the future in either a short or immediate-term bond fund versus placing in a high-yield savings account? Thanks and keep up the great work." Okay, well, great question. And let's start with interest rates. And for those watching the video, I'm going to show you the current Treasury yield. Now, this is as of the end of July. And what we can see is that in just the month since Will sent me that email, interest rates have gone from all-time lows to new and fresh all-time lows. The 30-year, as of July 30th, paid 1.2. So it's down roughly 30 basis points since Will sent his email. The 3-month T-bill, 9 basis points. That's kind of scary. We're almost into negative interest rates, right? Negative yields, I guess I should say. And so, yeah, interest rates have come down. But by the way, so have savings accounts. You won't find 1.25% anymore. You'll find closer to 1%. I'll talk about that in a minute. So it raises the question, where do we put our cash? Cash is trash, I guess they say now. What do we do with our cash? Well, part of it, in my mind, depends on what you're going to do with it. He mentioned 3 to 7 years, but what happens, like, why are you keeping it for 3 to 7 years? If you need the money because you want to buy a home, although 3 to 7 years is a fairly wide time period, but by golly, you got to buy it in, let's just say, 3 years. And you got to have exactly what you're going to have. If the fund goes down, you're going to be in big trouble. I would probably aim for something more secure, or more. Treasuries are obviously secure, more stable, I guess. But on the other hand, you know, if it's an emergency fund and you don't really know when you're going to need it, you're going to need it when an emergency happens. Well, then it kind of changes my own thinking a bit. But having said that, at the end of the day, I'm not sure it really matters much, and I'll tell you why I feel that way. Before I do, I should probably tell you where our cash is kept. We do have an emergency fund in a savings account. Ours is with Ally. Ally doesn't pay the highest interest rates. We'll look at that, but they're near the top, and right now, I'm pretty sure it's 1%. It could be 0.9. It's actually, check it out. Ally.com. What are you paying on your savings accounts? Yeah, 1%. So it's actually gone down in the last month, and who knows, it could go down again. So we keep an emergency fund of about 1 year's worth of expenses, which I know is probably more than we need to, but it helps me sleep at night, in Ally. And the rest is in our portfolio, stocks and bonds. We're roughly 75-25 in our allocation. And the bond fund, currently, I was in sort of an intermediate term bond fund. In fact, I was in VBTLX, the one that Will mentions. I've since moved to half intermediate term Treasury, half intermediate term TIPS. I think I've explained this in the past. TIPS are, of course, have an inflation insurance policy built in, right? If inflation, the idea behind a TIP is you're going to earn more when inflation kicks in and rates go up, but you pay for that policy. How do you pay for it? Well, you pay for it with a lower initial yield, right? One way to think about it is, because all these are done at auction, there's bidding. So they're bidding on how much they're going to pay for say a $1,000 bond. Just as an example, the auctions involve quite a bit more money than that. And people are willing to pay a little more for that insurance guarantee. Well, of course, when you pay a little more for a bond, your yield goes down, right? So the idea is if inflation turns out to be higher than we expect, the TIPS are really going to pay off. If it turns out it's lower than we expect, it's kind of like buying insurance that you don't need. You would have been better off with treasuries. And you know how good I am at predicting these things. So I say, okay, I throw my hands up in the air and say, okay, my days of predicting are over. I'm going to split my bond portfolio. Half goes to treasuries, hoping that the inflation is lower than we expect. And half goes to TIPS, hoping that inflation is higher than we expect. And I should be okay either way. The truth of the matter is, the Vanguard Total Bond Fund would be perfect. I mean, I switched. It probably ain't going to make a bit of difference at the end of the day. All right. So one thing that I want to point out here as we sort of address Will's question in a little more detail is this business about yields and interest rates. He mentioned in his email 1.5% roughly for 30-year treasuries. And we look at it a month later and it's down 30 basis points. That's a big drop. Well, what happens? We all should know this. When rates go down, what happens to the value of bonds? Well, let's take a look at an investment that I think you'd be crazy to invest in, and that's the Vanguard Long-Term Treasury Fund. Why is that crazy? Well, as Will pointed out, interest rates, I suppose in theory they can go lower, but someday they got to go up. And when they do, long-term bonds values, and we'll talk about why this happens, are going to go down. But check this out. This is from the Vanguard website. And this is the Vanguard Long-Term Treasury Fund. This is not one that Will mentioned in his email. Ticker is VUSTX. And if we come down here, the year-to-date return as of July 30th, 26.59%. It's been crushing it. Why? Well, because interest rates have gone down. Now, let's compare that to VBTLX. That's one that he mentioned. It's an intermediate term bond fund. And it invests in more than just treasury bonds. And we can look at it and we can come down to its year-to-date return, I think, maybe. Where is its year-to-date return? Bear with me. On the wrong tab. Here we go. Just under 8%, 7.91%. So, bonds are boring, right? So why is the long-term Treasury fund at Vanguard returned over 26% this year? And the total bond market index fund, which we know is an intermediate term bond fund, returned less than 8%. By the way, both quite good given what we've experienced in 2020. But why the big difference? So here's the deal. Imagine you buy a 10-year Treasury bond, a single, or it could be a corporate bond for that matter, but a single bond, you pay $1,000 for it, it pays 2%. And the next day, rates go sky high to 3%. And you decide, well, I don't want to be stuck with a 2% bond when I can get a 3% bond. So here's what I'm going to do. I'm going to sell the bond, take my grand, and invest in a new 3% bond. So you put it up for sale. I don't know, Craigslist, eBay, whatever. And you get a call and someone says, wait a minute, I'd like to buy your bond, but you want $1,000 for it. That's the face value, right? Right. Why would I give you $1,000 for your measly 2% bond when I can go get a brand spanking new one and earn 3%? And you realize the problem in your plan. Yeah, you ain't going to be able to sell it for face value. Now, you can sell it, but you got to discount it. Now, by how much? you have to discount it enough so that the person buying it effectively gets, you guessed it, 3%. And there's math behind it, which I've not bothered to learn because, I don't need to. Bond traders know it. Well, they probably don't either. They use a computer, but whatever. So you could sell it, right? You'd sell it at a discount. Let's just make up a number. Say you sold it for $980, and you could take that money and put it in the 3% paying bond, and the result would basically wash and be the same. But the point is, as interest rates go up, the value of your bonds go down. Now, we could reverse it. We could say, well, maybe rates didn't go up from 2 to 3%. They went down from 2% to 1%. Well, now the last thing you want to do, why would you want to sell your bond? It's paying 1% more. But if you did sell it, you could demand a premium. How much? Enough so that the buyer would effectively get the 1% return that current bonds are paying. Now, that's all fine and good for a single bond. When you invest in, let's say, VBTLX, you're investing in a heck of a lot more than a single bond. In fact, if we go to Morningstar, I'm doing this very quickly, hopefully. Let's see here. There it is. We can go to the portfolio, and it should tell us, yeah. You know how many bonds that fund holds? Just 17,941. Then they have other holdings, 208. Maybe options, I don't know what that is. In any event, how do we take what we know now about bonds and pricing and interest rates and values going up or down and apply it to a fund of bonds that holds almost 18,000 of them? That's a big spreadsheet. Well, there's an easy way to do it. We'll go to VBTLX. We're back at the Vanguard site. All we have to do is find the fund's duration. So you think about a bond maturity. You buy a 10-year bond and it matures in 10 years, meaning for 10 years you'll get your interest payments, and then at the end of 10 years you get your $1,000 back if it's a $1,000 bond. A year from now, the maturity on that bond will be 9 years. 2 years from now, 8 years, you get the idea. Well, duration measures something slightly different. It says, look, I don't want to know when the bond matures. I want to know you could think of it as the average weighted time for me to get all my money back. And at first you might say, well, isn't it the same as maturity? But the answer is no, it's not, because you're going to be getting interest payments along the way. It's not just getting your principal back. You're going to get interest payments. And so we have to factor that into the formula. And it's going to actually mean that the duration is some number, some time period shorter than maturity when we take that weighted average. And if you think about a zero coupon bond, what's that? That's one that doesn't pay interest. You end up paying a discount off the face value of the bond. Say a $1,000 bond costs you $900. 10 years later, you get the full 1,000 back, and that difference between what you paid and what you get is your interest payments, but you got to wait until maturity to get it. What's the duration of a zero coupon bond? I know if you're listening to this in the morning, you're thinking, Rob, it's way too early for this nonsense. Well, it's the same, right? Duration and maturity of a zero coupon bond are identical because you don't get any money until the very end. Most bonds, though, pay interest. You get money along the way. And so when you factor that into the magic formula, duration is something shorter than maturity. And it's affected, among other things, by the amount of the interest. You think about one bond that pays 1%, another bond that just will make up a crazy number, pays 20% interest. You're going to be getting some big payments on that 20% interest every 6 months. That will actually shorten the duration. So the lower the interest rate, the longer the duration. Anyway, so VBTLX, we can scroll down here. The duration is in here somewhere. I'm on the wrong tab again. There it is. Effective duration is 6.4 years. And you may be saying, Rob, that's just terrific, but what does that tell me? Well, as a general rule, if interest rates go up by 1%, the value of a bond will go down by 1% equal to its duration. So a 1% increase will lower the value of this bond by roughly 6.4%. A 1% decrease in interest rates will cause this fund to go up by 6.4%. Now let's apply that to long-term treasuries. And the duration, of course, as you know, long-term should be a clue. Duration is going to be a lot more than 6.5 years. And indeed, it is 18.4 years. So movements in interest rates will affect the value of this fund roughly 3 times more than the intermediate term bond fund. And we could go look at his short-term bond fund, VSBSX. Let me just put that in, VSBSX. It's going to pull up Yahoo, which I don't want. VSBSX. Thank you for your patience. All right, here we go. Back to Vanguard, and the duration is going to be very short, 1.9 years. So interest rate changes won't affect this as much. You could think of this kind of fund as closer to a savings account than an intermediate term bond fund, and much, much closer to a savings account than a long-term bond fund. Now, I know what you're thinking. Rob, this is just appreciate it. Great. What do I do? Where do I put my money? How does this answer Will's question? Well, it at least puts some context into the question. You certainly can, if you want the ultimate safety, and by safety I mean stability in the amount of money you have in the account. Savings accounts, yeah, make the most sense. Now, that being said, a short-term bond fund isn't going to fluctuate a whole lot, even with changing in interest rates. If we look at the performance of this particular fund, since interest rates have gone down, it's actually going to probably have beaten savings accounts this year, but I could be proven wrong, so let's see. No, it has. Well, let's see. Yeah, year to date, 3%. So it's done a little bit better than savings accounts, but of course interest rates have gone down. If they go up, it could do a little worse. So if you're really looking for stability, yeah, savings account is your best bet. I'm looking here now at the Dough Roller site, best online savings accounts. You see Vio Bank, they have listed 1.11% at the moment. I do a lot of research on bank interest rates, I guess because I have too much time on my hands. I generally find Vio to be one of the highest paying banks, but there are other options. Amex is paying 1%, CIT Bank 1%. I mentioned Ally earlier, it's 1%. So you'll find a lot of options at doughroller.net, my former website, but still near and dear to my heart. So yeah, if you want stability, I agree with Will. That probably makes the most sense. What you're giving up is the possibility of greater returns when interest rates fall. And I know you're saying, but Rob, they can't go any lower. Yeah, I've been saying that for a decade, so I don't know what to tell you. Your guess is as good as mine. I will say this. If you plan to keep the money in the fund for like up to 7 years, which is what Will said, even if rates go up, you're probably eventually going to end up with whatever the current yield is now. And here's how it works. Yes, the value of the fund will go down, and the fund will, in order to keep the duration of maturity that it's aiming for, it's in the case of an intermediate term bond, with intermediate term bonds, treasuries or corporates, whatever. I don't know if they invest in munis, but they have to buy and sell, right? Because a 7-year bond today, 4 years from now, is a 3-year bond, and that may be too short for the fund. So they're constantly buying and selling, and if interest rates go up when they sell, they're going to sell at a discount, right? We just covered that. But that's the bad news. The good news is they're going to be buying new, fresh bonds that, guess what, have higher interest rates. Or if they're buying them on the secondary market, we'll buy those potentially at a discount, but it depends where rates are. The point is, values will go down, but the yields will go up. And so given enough time, they kind of even out. So if you're thinking, I'm going to be in this for 7 years, frankly, personally, my gut instinct tells me it doesn't matter whether you do a short-term bond fund or a savings account. You're going to probably end up somewhere around the same. But if you really want stability, yeah, you're going to stability in terms of the value of the account. Savings accounts, are going to be your better option. I tend to like to take the risk a little bit, but not too much. So I'm in intermediate term bonds, but again, I still have my emergency fund in a savings account, and that's it. So there you go. I will say one last thing. Interest rates being so low as they are cause people to do what's called reach for yield. What's that look like? Well, it can mean investing in high yield stocks, even if the stocks are maybe not the most stable. A perfect example, Wells Fargo had a yield of like 9%. It's crazy. But there was a reason they had a yield of 9%. Their prices were the price of the stock was going down, which of course causes the dividend yield to go up, even while the dividend itself stays the same. And they ended up having to cut their dividend payment in order to satisfy. I don't know if the regulators required them to, or they just did it on their own, but to weather the storm. So their yield fell to 1.5%. So keep in mind that if you reach for yield, not all dividend-paying stocks are safe. Now, some will say, well, you just need to get the safe ones. Well, that's fine in theory, although the safe ones tend to have, lower yields. Why? Well, everyone knows they're safe and they're buying them, and the prices go up and the yields go down. There's no free lunch. Some people will pile into REITs, master limited partnerships. Again, these could be perfectly fine investments, but I think when you tend to tilt your portfolio to higher yielding investments, you tend to lower total return, and I'm just not a big fan of doing that. So for me, we're in a low yield environment and we're going to be here, I would think, for a while, but who knows how long, and that's just life. So hope that answers your question. Will is a great one. Basically my answer to you is I kind of agree with you. If you want stability, stay in a savings account. I probably would pick a savings account over a short-term bond fund. For my portfolio and the bond portion of it, I go with intermediate-term bonds because I'm too chicken to go with long-term bonds. And by the way, for point of reference, the 4% rule, which came out of a paper published in 1994 by William Bengen, we've talked about it many times, his portfolio assumed basically 50% S&P 500 and 50% intermediate-term treasuries. Well, there you go. There's my answer. Will, thanks for the great question. You can email me at dr@doorroller.net. It's a kind of a crazy email account at this point because it gets a ton of spam. So I would put in there, certainly mention the word podcast, or I will absolutely never see it. And alternatively, of course, you can leave questions on the Facebook group, doorroller.net/Facebook group. Hey, until next time, remember, the best thing money can buy is financial freedom.